Have you ever wondered about jumping into the exciting world of investing in stocks? It's like a thrilling adventure that many think about. But let's face it, we often hesitate because of the scary stories of financial crisis, bubbles bursting, and economic crashes we've all heard about. Well, get ready for a journey where we'll unlock some really cool investing secrets. Find out why it's smart to ignore Mr. Market and take control. Learn how to start your investing journey without risking real money. Discover why sometimes the cheapest stocks can be hidden gems. Intelligent investors are like smart detectives. They take their time to understand if a company is a good bet for the long haul. In the world of investing, there's a chance to make a lot of money, but there's also a chance to lose a lot. Think of it like this. Some folks, like Warren Buffett, got really rich by making the right choices in the stock market. But for every success story, there are just as many stories of people who made mistakes and lost everything. So here's the big question. Is investing worth the risk? The answer is yes, it can be, as long as you follow the strategy of intelligent investing. Intelligent investors do their homework and aim for steady gains. It's different from gambling, where people try to make quick money by guessing what will happen next in the market. Gambling is risky because, well, nobody can predict the future. Imagine this. A gambler hears a rumor that Apple is about to release an amazing new product and rushes to buy Apple stocks. If the rumor is right, they make money. If not, they lose a lot. On the other hand, intelligent investors focus on a simple idea. Buy stocks when they're priced lower than they're really worth. It's like getting a good deal while shopping. You buy a dress, and it's worth it if it lasts a long time. The same goes for stocks. They're worth it if they grow over time. The life of an intelligent investor might not be the most thrilling, but that's not the point. The point is making money. Let's break down the key principles of smart investing into 3 easy-to-grasp ideas. Principle 1. Investigate the company's long-term health. Okay, so before you jump into buying stocks, here's the deal. A stock's value isn't just random. It's directly linked to how well the company it represents is doing. So take a close look at the company's financial stuff, how good the folks running it are, and whether they share the profits with investors. That's called dividends. Don't get trapped in the short-term profit game. Instead, check out the company's history to see how it's been doing over time. This way, you'll get a better idea of whether a company is worth investing in, even if it's not the hot topic in the stock market right now. Sometimes, a less popular company with a solid track record can be a smart investment. Principle 2. Don't put all your eggs in one basket. Imagine this nightmare scenario. You've put all your money into one promising company, and then you hear they're in trouble for some serious financial wrongdoing. Poof, your investment's gone, just like that. To avoid this, don't bet everything on a single stock. Diversify your investments. Spread your money around different companies. That way, even if one tanks, you won't lose everything. Principle 3. Aim for steady gains, not get-rich-quick schemes. Let's get real here. The goal of smart investing isn't to become a Wall Street superstar overnight. It's about steadily building your wealth over time. You don't need to outdo the pros who do this for a living. Trying to make a quick buck can lead to trouble. Stay focused on safe and dependable returns instead. Now let's talk about stock market history. Before you dive into investing, there's something you should know. It's not just about looking at the history of individual stocks. It's about understanding the history of the whole stock market. Take a peek into the past, and you'll see that the stock market has always had its ups and downs. Sometimes these swings are totally unpredictable. That's why you need to be ready, both financially and mentally. Economic crises, like the big Wall Street crash in 1929, are just part of the game. You've got to make sure you can take a hit and still bounce back. This means having a mix of different stocks in your portfolio so you're not wiped out all at once. And when things get tough, don't panic and sell everything in a hurry. History shows that even after the worst crashes, the market eventually bounces back. So stay cool. Once you're confident the market is stable, then you can shift your focus to a company's history. Check how its stock price, earnings, and dividends have been performing over the past decade. Also factor in the inflation rate, which tells you how much your earnings are really worth in the grand scheme of things. For example, if you're getting a 7% return on your investment in a year, but inflation is eating away 4% of that, you're left with only a 3% gain. So think carefully before you jump into something for just a tiny return. When it comes to smart trading, knowing your history is like having a secret weapon. Keep it sharp, and you'll be well on your way to making wise investment decisions. Don't be fooled by the market's mood swings. Let's talk about understanding the stock market, and here's a fun way to imagine it. Picture the whole stock market as a person. We'll call him Mr. Market. Now, as far as people go, Mr. Market is a bit of a wild card. He's unpredictable, moody, and not all that clever. Mr. Market is easily swayed, which makes him swing from extreme optimism to unfounded pessimism. It's like when a new iPhone comes out, everyone gets super excited. Well, Mr. Market acts the same way. When something exciting is on the horizon, stock prices shoot up, and people are willing to pay a premium. So, when the market is too optimistic about the future, stocks become overpriced. But there are times when Mr. Market gets all gloomy for no good reason, and that's when you might want to think about selling. The smart investor doesn't get swept up in the crowd's emotions. You should tune out Mr. Market's mood swings. And here's the thing. When Mr. Market is in a good mood, he might make you see profits that aren't really there. Just because a stock is making money now doesn't mean it will keep doing so. In fact, stocks that have been on a winning streak are more likely to drop in value because demand has pushed their prices to the limit. Even knowing all this, it's incredibly tempting to chase after short-term gains. Our brains are wired to spot patterns, especially ones that promise good stuff. People are so good at it that even when psychologists show them random sequences, they still try to find a pattern. So when we see profits going up and up, we trick ourselves into thinking it's a pattern that'll keep going. By now, you're getting the hang of the basics of smart investing. The next round of insights will give you practical tips based on your unique investing style. Safety first for defensive investors. Now, let's talk about finding the right investment strategy for you. Are you more of a defensive investor or an enterprising one? We'll focus on the defensive investor for now. Defensive investors hate taking risks. They want their investments to be rock solid, safe, and easy to manage. To stay safe, you've got to diversify your investments. That means spreading your money across different things. Here's the game plan. First, put your money into high-grade bonds, stuff like AAA government debt securities. You can also invest in common stocks, where you own a piece of a company and get to vote on important decisions. Ideally, aim for a 50-50 split between the two. Or if you're super cautious, go for 75% bonds and 25% stocks. See, bonds are like the sturdy, slow, and steady option. They're not as profitable but are less risky. Stocks, on the other hand, are riskier but can bring bigger rewards. Diversifying like this covers both bases. Now, when it comes to your stock investments, make sure you spread the risk there too. Invest in big, well-known companies that have a history of success. Try to put your money in at least 10 different companies to lower the risk. I know this might sound like a lot of work, but don't worry, we'll keep it simple. When picking stocks, don't reinvent the wheel. Look at what successful investment funds are doing and mimic their choices. I don't mean follow the latest trends. Look for investment funds that have a proven track record and follow their lead. Lastly, always consider getting advice from an expert. They know the investing game better than most and can help you make the right decisions. Follow these straightforward principles, and you'll see the rewards of your prudence sooner or later. Investing made simple with a formula. Congratulations, you've picked the companies you want to invest in. The hard part is over. Now it's all about deciding how much money you want to invest regularly and keeping an eye on your stocks from time to time. In this phase, you'll use a super simple approach called formula investing. It's like having a recipe for success. You stick to a set formula that tells you how much to invest and how often. This is also known as dollar cost averaging, where you invest a fixed amount of money in a particular stock every month or quarter. So once you've identified a safe and solid stock, it's time to put your investments on autopilot. Start by committing to invest a certain amount, say $50, every few months. Then use that $50 to buy as many stocks as you can. The beauty of this approach is that it takes the guesswork out of investing. You won't end up investing too much, and you certainly won't be taking big risks. But here's the thing, it can be emotionally challenging. Even if your chosen stock is a total steal and you want to buy more, you've already limited yourself to spending only your present limit. Still, defensive investors should occasionally check in on their investment portfolios. A good rule is to review your mix of common stocks and bonds every 6 months. Ask yourself, are my stocks still making money? Is the ratio similar to when I first started, 50-50? And don't forget to consult with a financial pro once a year to talk about adjusting your investments. You've got the fundamentals to start your journey as a defensive investor. The next insights will unveil the strategies you need to be a successful enterprising investor. Enterprising investors begin like defensive ones. If you want to be a successful enterprising investor, guess what? You'll start by using a lot of the same strategies as defensive investors. Just like a defensive investor, you'll divide your funds between bonds and common stocks. But here's the twist. While defensive investors often go for a 50-50 split between stocks and bonds, enterprising investors lean more toward common stocks because they can be more profitable, though riskier. Just like defensive investors, enterprising ones should also have chats with a financial planner. But here's where it gets interesting. An enterprising investor sees their financial planner as a partner, not just a teacher. They make decisions together. Now here's the extra spice. Enterprising investors aren't just sticking to plain old stocks and bonds. They like to experiment with other types of stocks that have higher risks and potentially higher rewards. For example, you might hear about a hot new startup and think it could be the next big thing. It's a thrilling opportunity, and as an enterprising investor, you can take a calculated risk on it, but only with a limited portion of your money. No matter how exciting an opportunity seems, enterprising investors should cap these higher risk stocks at a maximum of 10% of their overall portfolio. Remember, even intelligent investors can't predict everything, and sometimes Mr. Market can be too unpredictable. Like defensive investors, enterprising ones also know that ongoing research and keeping an eye on their portfolios are crucial to keep the money flowing in. So whether you're more defensive or enterprising, you've got the tools to navigate the world of investing with confidence. Don't be fooled by market trends. Okay, imagine this: you own some stocks, and suddenly their prices drop. What do? Panic and sell them all. Or maybe another stock is skyrocketing. Should you jump in on the action before it's too late? Many investors act on these impulses, constantly buying and selling based on market ups and downs because they're afraid of losing money. But guess what? An intelligent investor knows better. Trusting Mr. Market, the moody guy we talked about earlier, can be risky. When a stock's price is shooting up fast, it might mean it's already too expensive for what it's really worth. Remember the US housing bubble a few years ago? Everyone was buying homes, and prices kept climbing until they became totally disconnected from their real value. And when that bubble burst, the whole market crashed. To avoid that kind of disaster, enterprising investors do the opposite. They buy when the market is down and sell when it's up. Keep an eye on your portfolio and the companies you've invested in. Ask yourself questions like, is the management still doing a good job? How's the company's financial health? If you notice that a company's stock is overrated and its price is soaring without reason, it might be wise to sell before it takes a nosedive. On the flip side, look for opportunities to buy when the market is down. For example, back in 2002, Yahoo! Incorporated snagged Inktomi Corp. for only $1.65 per share, and that was a steal. Mr. Market had gotten all gloomy after Inktomi shares had tumbled from a ridiculously overpriced $231.625 per share, even though the company wasn't making a profit at the time. Unleash your inner bargain hunter. Okay, by now the idea of being an enterprising investor might sound like an exciting challenge. But is it really worth the hassle of constantly keeping tabs on your investments? Well, the short answer is yes. It's definitely worth it, especially if you start smart. The best way to kickstart your journey as an enterprising investor is by virtually tracking and selecting stocks. Spend a year doing this to sharpen your skills in spotting bargains and keeping tabs on how your stocks are doing. Here's the cool part. There are loads of websites where you can make virtual investments. All you have to do is sign up to see if you can outperform the average results. This one-year practice period serves a few purposes. It helps you get the hang of investing and keeps your expectations grounded. Once you've had your virtual year, you'll be all set to go bargain hunting. And guess where the best deals are? In the stocks of undervalued companies. The market often undervalues stocks of companies that are either going through a rough patch or are currently not in the limelight. Imagine Enterprise B, the second biggest player in the refrigerator market. It's a big company that's been making decent, though not spectacular, profits for the past 7 years. But recently, due to a production error, it had 2 not-so-great months, which scared off some jittery investors and sent its stock price plummeting. But here's the twist. Once that production error is fixed, the company is likely to bounce back. An intelligent investor sees those falling prices as a golden opportunity. But let's be honest, finding these bargains isn't a cakewalk. That's why that year of practice is so crucial. If you can thrive in the virtual world, you're more than ready to make it in the real investing game. And there you have it, folks. The keys to intelligent investing in a nutshell. If you found this video helpful, don't forget to give it a thumbs up and hit that subscribe button for more valuable insights. Remember, the world of finance doesn't have to be intimidating. With the right mindset and strategies, you can take control of your financial future. So go ahead, embark on your journey as an intelligent investor, and let your money work for you. Thanks for tuning in, and until next time, happy investing.